Porsche has just reported one of the most shocking financial results in its modern history, a 99% collapse in operating profit from over 4 billion euros last year to barely 40 million. This isn't a typo, it's a collapse that forced Porsche to rewrite its strategy, to rethink its future, and if we're honest, to face the cost of its own ambition. So today we're going to break this down, what really happened, why it happened, and how Porsche digs itself out of it. Let's start with the facts. In the first 9 months of 2025, Porsche's operating profit dropped from 4.04 billion to just 40 million euros, a 99% decline. Revenue fell 6% to 26.9 billion. That's not terrible, not great either, but it indicates that the huge drop in profit isn't a revenue problem, but a cost problem. The company blames what it calls extraordinary costs, roughly 2.7 billion in write-downs and restructuring charges tied to its EV strategy, plus nearly 700 million euros in US import tariffs. Put simply, this wasn't just a slow sales quarter. This was Porsche cleaning up a mess it made while chasing its electric future. So why did it happen? Well, there are 4 reasons, all colliding at once. First, the cost of electrification. Porsche invested heavily in its next-gen EVs, new Taycan batteries, the electric Macan, and development of a hybrid 911 GTS. Those programs are expensive and some suppliers have failed or have been rescoped midstream. Second, China's luxury slowdown. Porsche's biggest global market is being hit by domestic EV competition and an economy that's cooled. Chinese buyers are pivoting to homegrown brands with stronger tech credentials.
This is Guangzhou. Traditionally, it was China's industrial heartland. Once known for its polluting cities, today the streets are a sea of green number plates. The roar of rush hour has become a gentle hum.
So green means it's an EV and blue means that it's not an EV. But look, green, here's an electric moped, another green one, another green one. The point is that for most countries, EV is seen as the future of driving, but for China, the future has arrived. It's here now.
Third, US tariffs. Roughly 700 million of Porsche's hit came from new import duties on EU-built cars. That's money straight off the bottom line. And finally, margin compression. Even where Porsche sells cars, profitability per unit is down. Materials, logistics and currency pressure all eat into that legendary 20% margin. Here's the truth, Porsche didn't fail because it built bad cars. It failed because it tried to serve too many masters at once. The EU wanted full electrification, investors wanted double-digit growth, customers wanted traditional Porsches. The result was a strategy stretched thin. Billions poured into EV projects while ICE models carried the weight of profitability. The irony? The very market Porsche is being propped up by, the US and the UK, are the least regulated on internal combustion. Yet they're paying the price for decisions to satisfy European policy. So how does Porsche recover? Step 1. Stabilise the lineup. The hybrid 911 and the ICE 718 refresh will buy time and bring the cars back that people want. Step 2. Right-size the EV push. Porsche now admits it moved too fast and too broadly. It's slowing battery investment and leaning on partners instead of building everything itself. Step 3. Defend pricing power. But defending pricing power doesn't necessarily mean restricting supply. In fact, Porsche may be quietly doing the opposite, easing 911 production to protect margins, while the EV side of the business finds its footing. The 911 is their financial safety valve, high margin, emotionally bulletproof, and immune to the volatility hitting EV demand. Wait times are already shortening in the US and the UK, which hints at a strategic shift. Rather than strangling supply to create scarcity, Porsche is now using the 911's desirability to keep cash flowing. If you start seeing more 911s available over the next year, that's not an accident. That's Porsche quietly turning its crown jewel into a stabiliser for the entire brand. Step 4. Rebuild confidence. These charts tell us the problem isn't demand, it's cost. If Porsche can reset its cost base whilst keeping emotion in its cars, this collapse could mark the bottom rather than the end. Porsche's 99% profit collapse looks terrifying, and it is. But it's also a reset moment. If they get it right, the next 5 years could redefine Porsche as a brand that balances heritage and innovation better than anyone else. If they get it wrong, they'll become the next warning case of what happens when regulation outruns reality. If you enjoy Porsche analysis and editorials, then join this channel and subscribe. Otherwise, I will look forward to seeing you in the next one.